Here's something that surprises a lot of Canadian investors when they first learn about it. Every time you receive a dividend from a US stock or ETF, Apple, Microsoft, an S&P 500 fund, anything American, the United States government takes a cut before that money ever reaches your account. Not the Canadian government. The American government. 15%. Gone. Before you see a single cent. Now, depending on which account you hold that investment in, that 15% is either permanently lost, partially recoverable, or, in one specific scenario, completely avoided. The difference between getting this right and getting this wrong, on a substantial portfolio held over 20 or 30 years, can amount to tens of thousands of dollars. Today we're going to cover exactly how this works. We'll talk about the Canada-US tax treaty, what it does and doesn't protect, the W-8BEN form every Canadian investor should know about, and a subtle but important wrinkle involving Canadian-listed ETFs that hold US stocks. Let's get into it. To understand why this happens, we need to understand a concept called withholding tax. When a company pays a dividend, that payment crosses a border, from a US corporation to a Canadian investor. The US government imposes a tax at the source. The company withholds a percentage of the dividend and remits it to the IRS before sending you the remainder. This is different from capital gains. When you buy Tesla at $100 and sell it at $200, the US does not tax that profit. Under international tax conventions, capital gains are taxed by the investor's country of residence, Canada, in your case. The US has no claim. But passive income, dividends and interest, is treated differently. The US claims the right to tax money flowing out of its borders, even to non-residents. Without any treaty, the default withholding rate on US dividends paid to non-residents is 30%. That means for every $100 in US dividends, $30 would go straight to the IRS and you'd receive $70. This is where the Canada-US tax treaty changes everything. The Canada-US Income Tax Convention was originally signed in 1980 and has been updated 5 times, most recently in 2007. It is one of the most comprehensive bilateral tax treaties in the world. Its core purpose is to prevent double taxation, to ensure that the same dollar of income isn't taxed in full by both the US and Canada. The treaty does 4 important things for Canadian investors. First, it reduces the withholding tax rate on dividends from 30% to 15%. That's the standard treaty rate for portfolio investors, individuals holding less than 10% of a company. You file a form called W-8BEN with your broker, and from that point on, US dividends are withheld at 15% instead of 30%. Second, it eliminates withholding tax entirely for certain registered retirement accounts. Specifically, under Article 18 of the treaty, US source dividend income earned inside an RRSP, RRIF, LIRA, or LIF is completely exempt from US withholding tax. 0%. The full dividend reaches your account. This is one of the most valuable and most underused benefits available to Canadian investors. Third, it sets the withholding rate on interest income at 0% for arm's-length transactions. This means that most US bond interest flows to Canadian investors without any US withholding. Fourth, capital gains remain exclusively taxed by Canada. The treaty confirms that the US does not tax capital gains realized by Canadian residents on the sale of US securities, with the notable exception of US real estate. To actually benefit from the reduced 15% rate, rather than the default 30%, you need to tell your broker that you're a Canadian resident. You do this by completing a form called the W-8BEN. The full name is Certificate of Foreign Status of Beneficial Owner for United States Tax Withholding and Reporting. The important word is foreign. You are certifying to the US that you are not a US person, and that you are entitled to treaty benefits. In practice, this is simple. When you open a brokerage account that gives you access to US securities, Questrade, Wealthsimple, TD Direct, RBC Direct, or any other Canadian broker, they will ask you to complete the W-8BEN during account setup. Many do this digitally. 2 important things to know. First, the W-8BEN expires after 3 years. Your broker should notify you when it's coming up for renewal. If it lapses without renewal, you may revert to the 30% default rate. Check your account settings periodically to confirm it's current. Second, the W-8BEN only affects the rate on dividends. It has no impact on capital gains, because the US doesn't tax those for Canadians regardless. The form is specifically a dividend withholding tool. This is the most practically important section of today's video. The same U.S. investment, in 3 different accounts, has 3 very different tax outcomes. Scenario 1, U.S. assets in an RRSP. This is the optimal scenario. Under Article 18 of the Canada-U.S. Treaty, U.S.-listed securities held directly in an RRSP are completely exempt from U.S. withholding tax. You receive the full dividend, 0% withheld. On a $100,000 portfolio of U.S. dividend-paying stocks yielding 2.5%, that's $2,500 in annual dividends. In an RRSP, you receive all $2,500. Outside an RRSP, you receive $2,125. The 15% withholding costs you $375 per year. Compounded over 30 years, that difference is significant. Additionally, everything inside the RRSP grows tax-deferred. You only pay Canadian income tax when you withdraw, ideally in retirement, when your marginal rate may be lower. The RRSP is the single best account for U.S. dividend-paying assets. Scenario 2, U.S. assets in a non-registered account. In a non-registered account, the 15% withholding applies. But it is at least partially recoverable. When you file your Canadian tax return, you can claim a foreign tax credit for withholding taxes paid to a foreign government. Canada's foreign tax credit for dividend withholding is limited to 15%, which is exactly what the U.S. withholds under the treaty. So in principle, you can fully recover the withholding through the credit. In practice, the recovery depends on your personal tax situation and whether you have sufficient Canadian tax owing against which to apply the credit. For most investors in a non-registered account, the foreign tax credit works reasonably well. You don't pay tax twice on the same income. You will receive a T3 or T5 slip from your broker showing the amount of foreign tax paid, which feeds directly into your tax return. Scenario 3, U.S. assets in a TFSA. This is the scenario where most Canadians lose money unnecessarily. The TFSA is tax-free in Canada. But the United States does not recognize the TFSA's tax-free status. The treaty exemption that protects RRSP specifically covers qualifying retirement accounts, and the TFSA is not on that list. It was created in 2009, well after the treaty's last major update in 2007, and it has never been added to the treaty's protected account list. The result, U.S. dividends paid into a TFSA are subject to the 15% withholding tax, and unlike a non-registered account, you cannot claim a foreign tax credit to recover it. Inside a TFSA, there is no Canadian tax owing, so there's nothing to credit against. The 15% is gone permanently. Let's quantify this. $100,000 in a TFSA invested in U.S. dividend-paying stocks at 2.5% yield loses $375 per year to irrecoverable U.S. withholding tax. Over 30 years at a 7% growth rate, the compounded cost of that annual loss is approximately $35,000. Here's the full picture side by side. Now we get to a subtlety that even experienced investors often miss. And it changes the calculus on some very popular Canadian ETFs. Many Canadians hold U.S. equity exposure through Canadian-listed ETFs, products like VFV, which tracks the S&P 500, or XUU, or ZSP. These are CAD denominated, listed on the TSX, and feel like Canadian products. But their underlying holdings are U.S. stocks. Here's the problem. When a Canadian ETF holds U.S. stocks, or holds a U.S.-listed ETF like VOO, the dividends from those U.S. stocks are subject to withholding tax at the fund level, before the money even reaches the Canadian ETF. This is called the Level 1 withholding tax. Then, when the Canadian ETF distributes that income to you, you're in whatever account you're holding it in. Think of it as 2 departure gates. The first gate is between the U.S. stock and the Canadian ETF wrapper. The second gate is between the Canadian ETF and you. The critical point, even inside an RRSP, the Level 1 withholding at the fund level is not fully protected by the treaty. The RRSP treaty exemption applies when you hold U.S.-listed securities directly. When you hold a Canadian ETF that in turn holds U.S. stocks, the treaty protection breaks down at the fund level. The 15% withholding happens inside VFV before the dividend reaches your RRSP, and your RRSP cannot claim it back. The solution: hold U.S.-listed ETFs directly inside your RRSP. If you hold VOO, IVV, or VTI, the U.S.-listed versions, directly inside your RRSP in US dollars, the treaty exemption applies cleanly. The withholding tax is zero at both levels. You receive the full dividend. The trade-off is currency. You need US dollars to buy US-listed ETFs. If your RRSP contributions are in Canadian dollars, you'll need to convert, either by using a service like Norbert's Gambit to minimize conversion costs, or by simply accepting the exchange spread. For most investors, the annual dividend yield of a broad US equity ETF is only around 1 to 1.5%. The withholding tax cost on VFV inside an RRSP is roughly 0.2% per year, meaningful over a lifetime, but not large enough to override all other portfolio considerations. The perfect should not be the enemy of the good. Here's the direct comparison. Let's address this directly because it's a common source of confusion. When you sell a US stock or ETF and realize a capital gain, the United States does not tax that gain. This is true regardless of which account you hold the investment in, RRSP, TFSA, or non-registered. The W-8BEN form has no bearing on capital gains, it only affects dividend withholding. Capital gains are, by international convention, taxed exclusively by your country of residence. Canada taxes your capital gains. The US does not. The one exception is US real estate. Under the FIRPTA rules, the US does impose a withholding on the gross sale price of US property sold by foreign persons. But for publicly traded securities, stocks and ETFs, capital gains belong entirely to Canada. Let me now bring all of this together into a clear, actionable framework. Rule 1. File your W-8BEN and keep it current. This is the baseline. Without it, you're paying 30% withholding instead of 15%. Your broker handles the mechanics, but you need to ensure the form is on file and hasn't expired. It's valid for 3 years. Rule 2. U.S. dividend-paying assets belong in your RRSP. The treaty exemption for retirement accounts means zero withholding tax on U.S. dividends in an RRSP. This is the single most valuable tax planning move available to most Canadian investors with U.S. equity exposure. Rule 3. For maximum RRSP benefit, hold US-listed ETFs directly. If you want the full zero withholding benefit, hold VOO, IVV, or VTI directly in your RRSP in US dollars, rather than their Canadian-listed equivalents like VFV or XUU. The difference is approximately 0.2% per year, small but real, and it compounds. Rule 4. US assets in a TFSA lose 15% of dividends permanently. The TFSA is excellent for Canadian stocks, high-growth assets with no dividends, or assets whose income would otherwise be taxed at your highest marginal rate. It is not the right home for U.S. dividend-paying assets. Rule 5. In a non-registered account, claim your foreign tax credit. The 15% withholding is largely recoverable through the foreign tax credit on your Canadian tax return. Don't leave it unclaimed. One final point that's worth mentioning. The treaty exemption for RRSPs applies to U.S. companies, stocks and ETFs whose dividends originate from U.S. sources. It does not apply to American depositary receipts, or ADRs, securities that represent shares in non-U.S. companies but trade on U.S. exchanges. If you hold a Japanese or European company through an ADR in your RRSP, you may still face withholding tax from the company's home country. Similarly, Canadian-listed ETFs that hold international stocks, not just U.S. stocks, may be subject to withholding taxes from multiple countries, some of which are partially or fully unrecoverable regardless of account type. The Canada-US treaty is specifically about the U.S. Other countries have their own treaties with Canada at varying rates, and the RRSP exemption is U.S.-specific. Let's summarize today. The U.S. charges a withholding tax on dividends paid to Canadian investors. Without action, that rate is 30%. With a W-8BEN filed, it drops to 15% under the Canada-US tax treaty. In an RRSP, that 15% drops further to zero, but only for US-listed securities held directly. Canadian-listed ETFs like VFV still lose a layer of withholding at the fund level, even in an RRSP. In a TFSA, the 15% is permanently lost, unrecoverable, because there's no Canadian tax to offset it. In a non-registered account, it's partially recoverable through the foreign tax credit. Capital gains. The US doesn't tax them for Canadians. Full stop. This video is the fourth in our Canadian dividend and tax series. Videos 1 through 3 cover how to evaluate dividend ETFs, the best Canadian options, and how to minimize tax across account types. Links are in the description. If you found this useful, please like and subscribe. Questions in the comments, I read all of them. See you in the next one. This video is for educational purposes only and does not constitute investment advice. Tax rules are subject to change. Please consult a registered CPA or financial advisor for advice tailored to your personal situation.